Extraordinary swings in the last couple of days. Some people taking positives from the last 2 days in particular, but you're not. You're still not deploying cash into stocks right now. Is that right?
That's correct. You know, I'm not a technician. I think the fundamental problem is the tariff wars, which have been started by President Trump. This is a self-inflicted wound, and until we resolve the issue, I really think there's going to be the market's going to be in flux. You know, from a statistical standpoint, the PE ratio in the S&P now is the lowest it's been in years. On today's close, based on roughly $167 in earnings next year, we're under a 15 PE. We haven't seen that in a lot of years, and the historical norm is 16 times. And if you looked at the Russells, the 1,000 value, 2,000 value, and 2,500 value, they're all in the 13 multiple range. And earlier in the year, most of them were over 20 times earnings. From a valuation standpoint, things are cheap. But macroeconomics is now dominating the markets, and that's the real issue. Individual companies and earnings don't seem to mean that much, as a lot of the companies are in free fall.
So what valuation would be enough to make you look past that macro headwind that we're talking about? 14 times PE, 13 times?
It's not really the PE ratio. The average PE in the Delphi portfolio now is 8 times next year's expected earnings with high returns on equity. It really has to be resolution of the tariff issue. You know, if you look historically at Smoot-Hawley, 1930, isolationism and nationalism didn't work prior to World War I, and it didn't work prior to World War II. And in fact, world trade crumbled between 1929 and 1932. It was down 67%. And what Mr. Trump has succeeded in doing is overturning GATT from 1950, NATO 1949, and he's disrupted the total supply chain, which is really important for things like technology, logistics like the FedExes of the world, auto and auto-related stocks, and general manufacturing. And the world has become globalized, and it's not like we can recede into the lower 48 and hope that somehow there's no repercussions, because there are repercussions.
So, as a value investor, you must be licking your chops if we do get some sort of trade deal early next year. Where would you go?
Yeah. Well, we're fully invested, to be frank with you. We always stay 85, 90%. There are companies that are cheap. My advice to a lot of people is, one, let it stabilize. But two, if you have to buy something, buy things that basically are domestically oriented or that have good sustainable earning power. And two bigger names that I would recommend to people at this point would be like Walt Disney. We've owned the stock for years. It's come off from about 118 to the low 100, selling at about 8 times next year's enterprise value. The other one would be AbbVie. Humira is the #1 drug in the world. It's about $19 billion. The stock's selling at a 10 PE. The stock has been crushed. It's it's got positive free cash flow, and the patents really don't expire till around 2024. But you should be very cautious on this market until it stabilizes. You know, it's like an earthquake. The initial one may be 7.8, but there are aftershocks, and it's better to wait, you know, and be cautious, because the aftershocks could still be disruptive.
Scott, what chance do you put of there being a recession in the U.S. economy this year, in the next 2 years, 2019 or 2020?
Okay. I don't think we'll have a recession, but I think we're going to ease back from about 3% this year at 2.9 to about 2.3. But I think Europe slows to around 1.5%, and world GDP, including the emerging markets, are going to slow to somewhere between 3.3 and 3.5. I think there are the prospects, if we don't get over this trade war, that we will go into a recession in 2020. And the other thing is, obviously, corporate earnings are slowing, and people are factoring that into their models. I mean, the consensus estimate for the S&P for next year is up over 8%. I'm at around 5%. But theoretically, you know, with earnings dropping quickly in the oil sector, it could be flat. So you could be really at $157 in earnings, which is going to be this year. And people will factor that in. And then on the other side, as you know, interest rates are moving up slowly. You know, we're roughly at the 2.5 level for the 2-year. But that puts a little bit of pressure on equity valuations. And I think it's the general uncertainty overhanging the global economies. Until that's resolved, I don't think the stock market goes anywhere.
But you don't think that even small caps can catch a bid or would be a good value here if you do think that this is all about trade and the big overhang from a slowdown in trade activity?
I really don't think that. I think that was a theme people played early on. I think the general market move dominates everything. I could say, honestly, 95% of my companies came in with record earnings in the third quarter. It doesn't matter. Even if you own 9 multiples or 10 multiple stocks, they all went down systematically. And one of the other issues is there were only 3,600 stocks. When I started in this business in 1980, there were 11,000. So most of these companies find their way into an ETF or an index, and when the baskets get sold, they go down simultaneously. It's not like there's individual stocks that do outstandingly well. That's a problem. That's more of a technical factor than a fundamental one.